Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. We begin this hour with markets on hold as a strong September payrolls report puts stocks on a 4-week winning streak. Yardeni of Yardeni Research thinks the Fed can take the rest of the year off. Following Friday's strong September employment report, Federal Fund Futures Markets predicts 5 or 6 rate cuts over the next 12 months. We're predicting none and done for the rest of this year. Yardeni joins us now for more. Yardeni, let's talk about that. Is that one jobs report enough to say they're done for the year?
I think it wasn't just the jobs report. We also had a very strong purchasing managers index for the services economy, and that's where the strength in the economy has been. Initial unemployment claims have remained very low, and so I think there have been actually quite a few numbers. As you know, the Citigroup Economic Surprise Index is positive again, and that's one of the reasons the bond yield is back up. It's a good indicator of the direction of the bond yield.
Ed, if you're right and they are done and we reprice this yield curve higher and we reduce how many interest rate cuts are priced for the next 12 months, how well does this equity market perform, in your opinion?
Well, I think it performs differently. I think we've clearly seen that this bull market has been led by the PE. The valuation multiple has gone up dramatically. Earnings have also been going up, which you wouldn't really have a bull market unless you really had earnings trending higher. And for the S&P 500 that are all-time record high, that's not the case for the mid caps, the small and mid cap S&P 400 and 600. Their earnings have actually been flat. I think the market continues to broaden, but instead of broadening out to the Russell 2000, which would be correlated with interest rates going down, if interest rates stay here, I think it broadens out from the Magnificent Seven to the S&P 493.
Ed, something is different, though, this time for this earnings season than it was in August. In August, we were talking about the high bar that equities had to reach. This time, it's somewhere below 5% that we're expecting earnings growth for this quarter. The bar is certainly lower. What does that mean? Earnings season is about to be upon us. Can this not be the leg of the next bull market rally, whether or not rates are being cut?
Well, it's my preference is exactly what's happening here. I would prefer that the market goes up on earnings from here rather than on valuation. This is not a cheap market. We've got the Buffett ratio. I think it's 2.8. It's at an all-time record high. That's the price to sales ratio. The forward PE for the S&P 500 is about 22, with the Magnificent Seven selling at almost 30. And the rest of the market at 19. So, you're not getting any bargains here. But what the market, I think, will do is go up on earnings. And we're going to have another quarter where earnings are going to go to a record high in the third quarter.
It has been a market, though, that has been able to rally without the Mag 7, without the mega caps for the most part. In the second half of the year so far, only 2.9% of the rally is attributed to those Mag 7 stocks, according to Bespoke. Ed, is it a market that, even though it is overvalued, at least is more healthy, at least is more broad?
Well, I think it's healthier if the stocks that go up that it broadens out to is the rest of the market, the rest of the S&P 500 beyond the Magnificent Seven. But again, those multiples which are at 19 could easily get over 20 here very quickly. And so I think the health of the stock market's going to depend on earnings. I'm a little nervous that everybody's turning so bullish, and all of a sudden everybody's talking about 6,000. I started out the year talking at 5,400 for the S&P 500 by year end, and that was an outlier. I had to raise that to 5,800, and now that's a meh kind of number where people are talking about 6,000. So I think there's a little bit a head of steam here building up that could be disappointed.
Ed, you were ahead of the curve. In your note today, you also talk about, before we get too cocky, you say we should note that we aren't completely ruling out the possibility of a recession. Right. What could trigger a recession for the U.S. economy right now?
Yeah, well, we had been thinking that the economy would surprise to the upside. We've been saying that for 2.5 years, that don't underestimate the economy, don't underestimate the consumer. Looking ahead here, we're thinking that the economy is going to continue to perform quite well. And so I think that's consistent with where the bond yield is. I think interest rates have normalized. I think the Fed really has to reconsider what is the neutral rate, which, by the way, I think is a fairy tale number. It doesn't exist. It's totally a theoretical construct. But all in all, I think the market goes higher on earnings.
Okay, but what about the geopolitics you also have one eye looking at?
Yeah, well, 20%, I don't want to get cocky about this thing as I wrote. I think there is a chance of a recession here, which is a 20% probability in our minds, and it is geopolitically related. I know it's a little bit hard to believe, but you look at the history of geopolitical crises, and more often than not, they've actually been buying opportunities. And the reality is this geopolitical crisis so far really hasn't given anybody a buying opportunity. So there's still a possibility that with this war between Iran and Israel getting to be a more direct confrontation, that there could be a sell-off related to that.
Ed, do you think there's a part of the market then that's a little bit too stretched? Is it an index level call, a sector call? What is it?
Well, I think that it's stretched in terms of valuation, and I think that part of that is because we do have a very passive investment orientation in the marketplace. So when people get into the market, more often than not, they're getting into ETFs, and ETFs really don't get very concerned about diversification. If if you have an S&P 500 ETF and 30% of that is the Magnificent Seven, that's what you're buying. Whereas managed portfolios might be more conservative, and so that's not enough diversification.
I just want to walk away with the right impression of where you stand, and I don't want to mischaracterize you for the rest of the weekend. At the moment, it sounds like you're bearish. Is that fair?
No, I'd say that our view is that we're at the right place in the market relative to valuation and earnings. I think we could get to 6,000. I guess what I'm saying is I hope we don't see a melt up here, because I don't like melt ups. They force me to have to figure out when to tell people to sell. And I think earnings are going to continue to drive the market higher at a slower pace.
So, Ed, if you think that we can continue to move forward, but there's some distortions in the market, it's overvalued, are you in the Cliff Asness camp of AQR, that this is a less efficient market and that these types of mispricings can continue on for longer because of forces like passive management?
I think that's a very good point. I agree with that. But at the end of the day, that's a theoretical notion, and the bottom line is this market going higher? And I think it is going higher. Look, we got $6 trillion sitting in money market mutual funds. They're an all-time record high, and so is the stock market. In other words, the stock market got to a record high without people actually panicking out of money market funds and getting into the stock market. So there's a tremendous amount of liquidity in the system. And there's a lot of buying on a global basis. I would continue to overweight the U.S. on a global portfolio. I think the China thing's kind of running out of steam here. And I think people are going to go back to overweighting the U.S. as kind of the safe haven in the global stock market arena.
Yardeni, let's finish there. What is it about China that you don't believe in?
Well, they've got some major structural problems. They created, the government created its own mess here with the demographics. They got a very rapidly aging demographic profile. The consumers are stretched. I don't think they're going to be buying additional apartments. So even if they manage to stop the debacle in the property market, that's not going to be a source of economic growth. All in all, it's a government run, it's an autocratic government running an economy that's done extremely well when they let capitalism flourish. Now they're not.
Ed Yardeni of Yardeni Research. I'd appreciate it, sir. Katrina Dudley of Franklin Templeton writing, we continue to believe in a soft landing, which is bullish for equities compared with the more bearish expectations of an imminent recession. Katrina is with us around a table here in New York. Katrina, good morning.
Good morning.
Let's start on Friday. It's like Friday never ended. What did you make of that?
I think that we've had some bullish momentum in the market. We have been in the soft landing camp for a long period of time in terms of we think that there are so many tools that have been available to be able to kind of land this economy on that landing strip and do something in terms of, managing the inflation and getting that down, which I think we can kind of check mark on that. We'll see the data that comes later this week. You look at the employment outlook, it's been bullish, people are good. And so I think that the Fed has actually done a very, very good job here.
There's a feeling on Friday that good news is still good news. Equities were higher, bond yields were too. They're up again this morning by 7 basis points at the front end, on a 10-year up by 3. Should they be anxious? Should equity bulls be anxious about what's developing in the bond market again?
I think that I grew up where we used to look at the bond market and it would inform us as equity investors, and now I think that the narrative has shifted. I think that we've got so many indicators coming out of equity markets, and I think that the equity markets have been at the forefront of some of the bond markets. So,
Katrina, you also, though, mentioned some of the bearishness in the technical backdrop, the fact that hedge funds need to take down their exposure with the volatility, that corporates are in a blackout period. How much does that weigh on a potential rally in this equity market?
I think if you combine those two things, which are the kind of the hedge fund exposure, you look at the fact that we've got this blackout period, and buybacks have been a big driver of some of the earnings growth as well as the incremental buyer in the market. And then we cannot forget about the election. The election is causing uncertainty because we actually don't know who's going to win this time. And, for a lot of people, that's good news because it means it's still up in the air and there's still a chance for one candidate to pull ahead. But when you have uncertainty, the market doesn't like it. You'll see, the kind of those spikes in volatility, and you'll see that uncertainty get priced in.
But for risk, with a really strong backdrop, how much does the election really matter? Besides the rhetoric, the potential volatility, does it really change the long-term outcome when you have earnings and expectations are really low, a potential bar to beat, and again, a labor market that's very strong?
I think in terms of the election, first of all, I think on tariffs, we're in agreement that both parties have got incentives to continue that tariff regime. So I think that way we can kind of say, doesn't matter which side, but think about taxes. That is the area. And taxes, I always look at an income statement. It's a big number. And so if you have you've got a lot of disparity in policy, particularly as it relates to corporate taxes. And obviously, if you have a regime where there's a reduction in the corporate tax rate, that is bullish for equities and the offset. So I think that that's the unknown that we have. And no, I don't think we're going to have the next day change in tax rates. But it could happen fairly quickly, particularly if you get a Republican sweep.
Well, also because TCJA is expiring next year, so taxes are completely in focus. But if you're concerned about the corporate tax rate, do you care more about the composition of Congress than you care about who's in the White House?
I still do care about who is in the White House because I think that that is the driving force. That is a representation of America. So I think that they're the person who kind of drives where we end up as a policy. I think, as a country, we have this kind of tension in that we do believe that lower taxes are good for America, they're good for American business, but we do obviously have, some fairly high deficits out there.
We do, and there's new projections actually what those deficits would look like from Washington, from the Congressional Budget Office, about whether tariffs or Trump. You mentioned inflation and tariffs. If you think both of these candidates are interested in using tariffs as a policy, and we just got data that showed wage growth accelerated, by next year, shouldn't we be concerned again with inflation?
I think on the wage growth, that's a really big lagging indicator in terms of the inflation outlook. So I would say that any kind of job-related inflation lags what we expect to see. In terms of how do we expect tariffs to impact, it really depends on how we respond to them. If I have a company, a small company, and the alternative is to buy something domestically versus a cheaper Chinese import that suddenly gets inflated up. It's good for America because I'm doing that in-house. So I think that the inflation number, it's not directly a corollary of the fact that I'm increasing tariffs and then suddenly I'm going to see inflation in America. I think it really is going to depend on what that adjustment is. And I think a lot of companies have been doing a lot of actions where they're matching their manufacturing to where they're selling so that these tariffs may not be as impactful as we initially thought.
Let's get your equity calls. The US versus the the rest of the world? Within the US, large versus small, how are you thinking about things?
I think in terms of the US market, the momentum of the US market, and that is something that we're bullish on. We are concerned about that concentration. We've looked at the concentration, and there's no necessary research that kind of says, well, a highly concentrated market will sell off X% because you have different situations. So on the concentration, though, that is something that worries us. We do see a situation where you can have some of these large cap companies flattish, and that means that they're going to grow their earnings, which is what the market's expecting, and they're going to grow, the valuation will decline as the earnings increase, and you kind of had a kind of tepid market return, and that's good for the overall equity market. What we're seeing is that now that bullishness in the top of the market is starting to filter down. Where I think people are focused is going straight to small caps, but I think that there's actually a really big middle in America that is getting ignored, and that's the part of the market that I actually like at the moment. The small caps, in a regime where you're anti-FTC, may not have that takeout premium, so there's a little risk there, but that mid part of the market, I think, could actually be where opportunity
is. There a sector preference within the mid caps?
In terms of sector preference, I would go towards some of the industrial names where I think that they've got that resiliency to be able to take advantage of moving things around, that they're not going to be hurt by that rising tariff regime, and maybe they've got some ability to benefit from new policy.
There has been some of that. The Mag 7, it's 30% weighted in the S&P. Bespoke points out it's only accounted for 2.9% of the index's gains so far in the second half.
Yeah.
Is it a healthier market now?
I don't think it's quite yet healthy. I think you've still got those magnificent seven still dominating. Even the numbers you quote sound very small, but it's still dominating returns and dominating the narrative. I think that what we're seeing, however, is people starting to look at what are the second derivatives of, say, the AI, and that's where they're going into the mid-cap names. I also think that some of the exposure that you're looking at in the Magnificent Seven, people are starting to say, well, maybe I don't want an NVIDIA, I want an NVIDIA that, the second derivative, so the picks and shovels.
Do you understand at this point how big cap tech reacts to lack of Fed cuts, lack of magnitude of Fed cuts at this point?
In terms of understanding, I think that we have to go back to Finance 101. I'm so sorry, but the problem with some of these names, when you've got such high earnings growth expectation, which they're delivering on, let's to be very clear, any type of movement in interest rates, so much of the value is sitting in that terminal number that, interest rates become something that they're very, very sensitive to, even though you would say they're probably the least levered companies and they would have the least short-term exposure. But the valuation component and that terminal formula is what's really driving them.
Katrina, it's good to see you, as always. Thanks
you
for catching up with us. Katrina Dudley there of Franklin Templeton. Bob Dole of Crossmark Global Investments suggests it's hard to be bearish. Monetary policy is now easing, even though there is limited evidence that it had been a major drag for the US economy to begin with. Any caution towards equities has admittedly been wrong, or at least premature. Bob Dole joins us now for more. Bob, welcome back to the programme, buddy. Let's just pick it up where we left things on Friday. Payrolls, big blowout jobs report is good news when you're seeing this repricing in the bond market.
First of all, it was 1 month. Look at all the prior months. How many downward revisions have we had? I'm not saying it wasn't a good number. It was an outstanding number, no question about it. But when you look at the employment data around the ISMs, both manufacturing and services, they were weak. So which is it? Which has it right? Time will tell. But the inflation question, as you've all just been discussing, is back on the table.
So, Bob, it just raised an important question. Which one was the head fake? The summer deceleration or the re-acceleration coming out of the summer?
I think they're both true. Economies don't move in one direction nonstop. So I think we're going to have this fits and starts. Some people call it a bumpy landing. I like that term. And I think that's what we're in for. It's going to be a good number and then a not so good number. And it'll confuse all of us.
Yeah, great, wonderful. Great to hear that, Bob. I know in the meantime, you are looking for a significant economic slowdown or mild recession. That had been at least your base case scenario. If this is just 1 month, does it change it at all, Bob?
It certainly lowers the probability of us getting that right. when I look at all the statistics over several months, to me, it's still pretty clear that the economy is slowing. We're seeing that in many of the employment numbers, notwithstanding last Friday's. We're seeing that in ability to find jobs, people trying to find full-time jobs, settling for part-time jobs. Economy slowing. We just don't know how fast that's happening. And of course, the Fed has seen some of that too. We got 50 basis points. But you know, their number is still very high relative to other things. How many things can you find that have nominal growth as strong as the Fed funds rate now? So it is leaning on the economy even with this cut.
Can you just help me sort out then what kind of economic environment we're dealing with here, Bob? If you're worried about a slowdown, but now we need to worry about inflation again, how do you square all of those?
Oh, that can happen in many, many cases in the past. Economy slows and inflation's picking up. I'm not arguing for stagflation, but we've had that many times before. And I guess I should enter the fact that PEs are in the 20s. When the PEs are that high, things better be nearly close to perfect. So if there's fly in the ointment, whatever that fly is, that 22 PE has got to be questioned somewhat. Hard to see a lot of upside for equities. Maybe not downside, but hard to see upside.
Bob, I know you keep trying to stress that this is just 1 month, but how do we reconcile how good this month was, which all the survey data showing that actually jobs plentiful, that's coming down, while jobs hard to find, more people are saying that's what their picture is right now in the labor market.
That's why I'm raising the question that it's 1 month and all the other things, the same statistic prior months, all the other numbers are showing not so fast that the economy is great and that there are plenty jobs. So let's see what next month brings and watch all the other statistics as you just accurately point out.
Do you just then take maybe 60 or 70 off this payrolls report because of the revisions we've seen in the past?
That's probably not a bad thought. I hadn't come to grips with that, but that's probably a good idea.
Bob, I want to talk to you about what's happening in this bond market. We're starting to see a reinversion, never mind a disinversion. And Bob, I wonder for an equity market strategist, for an equity market investor, what they should be doing with what's happening in the bond market after we heard from tons of people coming on this program who were saying get out of cash, deploy it into risk, go out further along the bond market, take on duration in the bond market, take on credit risk. Bob, what's your advice now?
Yeah, I think people that have a lot of cash that have enjoyed high returns, put a little to work. The 10-year over 4 is a whole lot more interesting than the 10-year that was below 375, not but a couple of weeks ago. So I would take periods of weakness in the bond market and do some adding. You don't have to be a hero. Take your time. But that's what's weighing on the stock market, the rise in interest rates, the rise in oil prices. And, maybe the economy is okay, the employment report may say. But on the other hand, why are earnings revisions so negative for the third quarter?
Hold up, Bob. This is an important point. Are you suggesting we've got to the point in the bond market where yields up on good news is now bad news for equities?
Yes, I think, most people say when the 10-year gets above 4, we begin to have those problems. I don't know if it's exactly 4, but the pace of the increase in yields also, John, I think has to be brought into the equation, and that is weighing on stocks.
So let's get into the stock market. Lift the lid on the index. Where do you want to be? Where do you want to avoid with all of that in mind?
So I'm a broken record for quite some time. I've argued for companies with high earnings predictability, high earnings persistence, and strong and growing free cash flow. You might call that quality because all the unknowns we've been discussing and debating back and forth here, I want to have companies that are somewhat independent of the economy. Those stocks have done just fine as the market has moved higher. I think if we get any kind of selling squall, these names will do even better.
Bob, does that mean this market's ability to broaden out, to go beyond the Mag 7, go beyond the cash-rich companies, go into small caps? Do you not see the market able to do that then if you're still looking at this maybe safer part of this equity market?
So I'm not sure that the Magnificent Seven or Five or whatever the number is the safest part because of the big valuation differential between the top 10, if you will, more than 30 times earnings, and the other 490, call it 18 times earnings. I think the market can continue to broaden. I'd say within the S&P, within large cap stocks, not so much down to small. We need confidence that we have a really good economy for the small stocks to do well. And as you probably know, almost half of the Russell 2000 companies are losing money. That's not real attractive.
So, Bob, in this environment where higher yields can indeed punish equity markets yet again, how worried are you for Thursday's CPI report?
I think we have to have our antenna up on it. Look, I never say, back to the employment report, 1 month makes a trend, but this notion that the Fed had inflation under control, it's going to inevitably get to 2%, has to be in question. I've questioned all along. I don't think there's any way we get 2% inflation unless we have a recession.
Bob Dole at Crossmark. Bob, appreciate it, sir. You've been pretty consistent on that point. Good to catch up after payrolls on Friday. Looking ahead to CPI on Thursday.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.